Developed by J. Wells Wilder, the Relative Strength Index, RSI, is a momentum oscillator that measures the speed and change of price movements. RSI oscillates between 0 and 100. According to Wilder, RSI is considered overbought when above 70 and oversold when below 30. Signals can also be generated by looking for divergences, failure swings and centerline crossovers. RSI can also be used to identify the general trend. RSI is an extremely popular momentum indicator that has been featured in a number of articles, interviews and books over the years. In particular, Constance Brown's book, Technical Analysis for the Trading Professional, features the concept of bull market and bear market ranges for RSI. Wilder features RSI in his 1978 book, New Concepts in Technical Trading Systems. This book also includes the parabolic SAR, average true range and the directional movement concept, ADX. Despite being developed before the computer age, Wilder's indicators have stood the test of time and remain extremely popular. The default look-back period for RSI is 14, but this can be lowered to increase sensitivity or raised to decrease sensitivity. 10-day RSI is more likely to reach overbought or oversold levels than 20-day RSI. The look-back parameters also depend on a security's volatility. RSI is considered overbought when above 70 and oversold when below 30. These traditional levels can also be adjusted to better fit the security or analytical requirements. Raising overbought to 80 or lowering oversold to 20 will reduce the number of overbought/oversold readings. Short-term traders sometimes use two-period RSI to look for overbought readings above 80 and oversold readings below 20. According to Wilder, divergences signal a potential reversal point because directional momentum does not confirm price. A bullish divergence occurs when the underlying security makes a lower low and RSI forms a higher low. RSI does not confirm the lower low and this shows strengthening momentum. A bearish divergence forms when the security records a higher high and RSI forms a lower high. RSI does not confirm the new high and this shows weakening momentum. Chart on the screen shows eBay with a bearish divergence in August-October. The stock moved to new highs in September to October, but RSI formed lower highs for the bearish divergence. The subsequent breakdown in mid-October confirmed weakening momentum. A bullish divergence formed in January to March. The bullish divergence formed with eBay moving to new lows in March and RSI holding above its prior low. RSI reflected less downside momentum during the February to March decline. The mid-March breakout confirmed improving momentum. Divergences tend to be more robust when they form after an overbought or oversold reading. Before getting too excited about divergences as great trading signals, it must be noted that divergences are misleading in a strong trend. A strong uptrend can show numerous bearish divergences before a top actually materializes. Conversely, bullish divergences can appear in a strong downtrend, and yet the downtrend continues. Chart on the screen shows the S&P 500 ETF with 3 bearish divergences and a continuing uptrend. These bearish divergences may have warned of a short-term pullback, but there was clearly no major trend reversal. Wilder considered RSI overbought above 70 and oversold below 30. Chart on the screen shows McDonald's with 14-day RSI. This chart features daily bars in gray with a 1-day SMA in pink to highlight closing prices, as RSI is based on closing prices. Working from left to right, the stock became oversold in late July and found support around 44. Look at number 1. Notice that the bottom evolved after the oversold reading. Bottoming can be a process. This stock did not bottom as soon as the oversold reading appeared. From oversold levels, RSI moved above 70 in mid-September to become overbought. Despite this overbought reading, the stock did not decline. Instead, it stalled for a couple weeks and then continued higher. 3 more overbought readings occurred before the stock finally peaked in December. Look at number 2. Momentum oscillators can become overbought, or oversold, and remain so in a strong up or down trend. The first 3 overbought readings foreshadowed consolidations. The fourth coincided with a significant peak. RSI then moved from overbought to oversold in January. The stock ultimately bottomed around 46 a few weeks later. Look at number 3. The final bottom did not coincide with the initial oversold reading. Like many momentum oscillators, overbought and oversold readings for RSI work best when prices move sideways within a range. Chart on the screen shows MEMC Electronics, WFR, trading between 13.5 and 21 from April to September 2009. The stock peaked soon after RSI reached 70 and bottomed soon after the stock reached 30. Wilder also considered failure swings as strong indications of an impending reversal. Failure swings are independent of price action, focusing solely on RSI for signals and ignoring the concept of divergences. A bullish failure swing forms when RSI moves below 30, which is oversold, bounces above 30, pulls back, holds above 30 and then breaks its prior high. It is basically a move to oversold levels and then a higher low above oversold levels. Chart on the screen shows Research in Motion, RIM, with 10-day RSI forming a bullish failure swing. A bearish failure swing forms when RSI moves above 70, pulls back, bounces, fails to exceed 70 and then breaks its prior low. It is basically a move to overbought levels, followed by a lower high beneath those levels. Chart on the screen shows Texas Instruments, TXN, with a bearish failure swing in May to June 2008. In technical analysis for the trading professional, Constance Brown suggests that oscillators do not travel between 0 and 100. This also happens to be the name of the first chapter. Brown identifies a bull market range and a bear market for RSI. RSI tends to fluctuate between 40 and 90 in a bull market, or uptrend, with the 40 to 50 zones acting as support. These ranges may vary depending on RSI parameters, strength of trend and volatility of the underlying security. Chart on the screen shows 14-week RSI for SPY during the bull market from 2003 until 2007. RSI surged above 70 in late 2003 and then moved into its bull market range, which is 40 to 90. There was one overshoot below 40 in July 2004, but RSI held the 40 to 50 zone at least 5 times from January 2005 until October 2007. Look at green arrows. In fact, notice that pullbacks to this zone provided low-risk entry points to participate in the uptrend. On the flip side, RSI tends to fluctuate between 10 and 60 in a bear market, or downtrend, with the 50 to 60 zone acting as resistance. Chart on the screen shows 14-day RSI for the US dollar index during its 2009 downtrend. RSI moved to 30 in March to signal the start of a bear range. The 50 to 60 zone subsequently marked resistance until a breakout in December.